Index funds and dividend stocks are two popular investment choices, each with unique advantages. Choosing the right one depends on factors like risk tolerance, income needs, and long-term goals. An index fund is a type of mutual fund or exchange-traded fund, ETF, that tracks a specific stock market index, like the S&P 500 or NASDAQ 100. Instead of picking individual stocks, you invest in a basket of stocks that mirror the overall market. Index funds offer diversification, meaning your money is spread across many companies, reducing risk. They also have low fees since they are passively managed, meaning there's no fund manager constantly making trades. Over time, index funds provide steady long-term growth, making them ideal for retirement accounts and passive investors who want to build wealth without frequent trading. However, index funds don't focus on regular cash payouts, so they may not be ideal for those looking for steady income. Dividend stocks, on the other hand, are individual stocks that pay out a portion of their profits to shareholders in the form of regular dividend payments. These companies are often well-established and financially stable, like Coca-Cola, Johnson & Johnson, or Procter & Gamble. Investors receive quarterly or monthly dividend payments, creating a passive income stream. Over time, many dividend stocks also grow in value, providing both capital appreciation and regular income. However, investing in individual stocks carries higher risk, as poor company performance can lead to dividend cuts or stock price declines. Managing a portfolio of dividend stocks also requires more research than investing in a broad index fund. Now, let's compare them side by side. Risk and diversification. Index funds offer broad diversification across many stocks, lowering risk. Dividend stocks focus on fewer companies, which can be riskier if one company underperforms. If you want lower risk and broad exposure, index funds are better. Income versus growth. Dividend stocks provide regular income through dividend payouts, while index funds focus on long-term growth with fewer payouts. If you want passive income, dividend stocks win. But for steady market growth, index funds are the better choice. Fees and management. Index funds have low fees because they are passively managed. Dividend stock investing requires active management, meaning you need to research and adjust your portfolio. If you want a hands-off approach, index funds are easier to manage. Market performance. Index funds generally match the market's performance, which historically grows over time. Dividend stocks provide both stock appreciation and income, but individual companies can underperform. If you prefer consistent returns, index funds win. So which one is the better choice? If you want long-term growth, diversification, and low fees, an index fund is the best option. But if you prefer regular income and are willing to manage individual stocks, dividend stocks are the smarter choice. The best option depends on your financial goals and risk tolerance.